What does roll yield in commodity contango? Imagine you're holding a futures contract for oil, and every few months you need to replace it with a new one to keep your investment going. This process is called rolling over. Now, in some markets, the prices for futures contracts with later delivery dates are higher than those for closer dates. This situation is known as contango. It often happens because storing the commodity costs money, like storage fees, insurance, and interest on loans. When you roll your futures contract in a contango market, you sell the near-expiring contract at a lower price and buy a longer-dated one at a higher price. This means you pay more for the new contract than you received from selling the old one. The difference is called a negative roll yield. Over time, this negative roll yield can eat into your profits, especially if you keep rolling contracts in a market with persistent contango. It is important to understand that roll yield is just one part of the total return from investing in commodities using futures. The other part depends on how the spot price of the commodity moves. If the spot price rises, it can offset some of the losses from negative roll yield. But in a contango market, the ongoing cost of rolling contracts at higher prices can slow down your overall gains. This is especially true for exchange-traded funds or funds that track futures contracts. These funds must regularly roll their positions, and if the market stays in contango, their performance can lag behind the actual spot price of the commodity. To sum up, roll yield in a contango market is the negative return that happens when you roll futures contracts forward in a market where longer-term contracts are priced higher than shorter-term ones. Knowing this helps investors understand why futures-based investments might not perform as well as they expect, especially in markets with strong contango. It's a key concept for anyone looking to understand how commodity markets work and how to manage investments in futures contracts effectively.